Welcome everyone to the call. This is Triangle Blockchain Development Call tonight. And tonight we have the special guest, which is Eric Moore. And Eric's going to be going over some SHLDQ updates tonight and some other great, incredible information. And so without further ado, ladies and gentlemen, we have Eric Moore. Go right ahead, E.
Okay, thank you, Blair. Okay, hello, everybody. This is the third update, the third Zoom update on the Sears Holdings investment. We're going to call it the Sears Holdings bankruptcy because our property and our cash is not in bankruptcy. So what I'm going to do tonight, based on my emails, based on some comments, based on personal conversations with a few of you, I'm going to cover a little bit of information on the process of what bankruptcy actually is. So I want everybody to bear with me. I'm not going to do a long time, but I'm going to give everybody some basic information so you can better understand what's happening with Sears Holdings. I'm going to give you some examples of some companies that were in bankruptcy that investors made a lot of money on, some of which I was involved in, some of which I profited from. And I'm going to show you why Wall Street misses these opportunities, so to give you a better understanding, excuse me, and you don't feel so lonely trying to figure out some of the so-called complex legal stuff. So I'm going to give you the basics of bankruptcy, what it is, and I'm going to give you a couple of quick examples, and I'm going to show you a couple of short videos and some documents, and kind of give you a better understanding of what bankruptcy is and what the purpose is, because you probably have a lot of misinformation about what bankruptcy is, and you probably, and definitely based on what's being talked about online, you have a lot of wrong information. So first off, I want to start off. Sears Holdings is a holding corporation. A holding corporation owns stock or owns interest in other businesses. So if I name the company Sears Holdings Corporation, I could have 100 different businesses or 1,000 different businesses owned by Sears Holding Corporation. So another example is Berkshire Hathaway Holding Corporation. This is the corporation that Warren Buffett owns. They have literally 45 or 50 different businesses. It's called Berkshire Hathaway Holdings Corporation. Now, this office that Warren Buffett works out of has about 15, I think 20 people in it maybe, and they control a business worth over $750 million. They have Dairy Queen, Geico, major other large insurance companies. They own Fruit of the Loom. They own lots and lots and lots of other businesses and corporations. They own the largest railroad in the country. All of these are separate businesses owned by the holding corporation, Berkshire Hathaway. Now, you can name your holding corporation after one of the businesses, because Berkshire Hathaway Textile Mills was one of the businesses in 1965. But that particular business was converted into a holding corporation around 1966, and they just kept buying other businesses. So the greatest investment of all time from top to bottom is Berkshire Hathaway. And the reason for the first 25 years of the company being available to buy that nobody purchased this company is because people thought it was a textile mill. And textile mills were closing in the 60s when Warren Buffett took control. Just like large major retailers right now are closing. But what people did not know in 1965, 66, 67, all the way up to 1980 is that Berkshire Hathaway was not just a textile mill. It was a holding corporation that owned other businesses that were separate from the textile mill. They had loan agreements with banks separate from the textile mill. So what this means, everybody, is you can have a retail business called Sears and a retail business called Kmart. And you could have a business called Kenmore, business called Craftsman, a business called, what's the other, Craftsman, Kenmore, I'm sorry, Craftsman, Kenmore, and Die Hard, I'm sorry, thank you, and Die Hard, or Innovel Solutions. These businesses are actually separate from Sears and Kmart retail. And what I mean by separate, guys, is that if Sears, the retail store, owes $1 billion to Bank of America, Bank of America cannot go over to Die Hard or Kenmore or Craftsman and say, where's my money? So even if you put the entire holding corporation into bankruptcy, which is what Sears Holdings did, no creditors show up unless you borrow money. So Kenmore did not borrow money. So no creditors showed up. Does everybody here know that a creditor is a lender or somebody you owe money to? I want to make sure that's clear. And the debtor is Sears Holdings Corporation or whoever files bankruptcy. There are 3 types of bankruptcy. There's a Chapter 7, which is a liquidation. You sell everything, whatever's left goes to the people you owe. There's a Chapter 13, which could be a restructure or liquidation, but you can't make more than you can't owe more than about $2 million in debt and file a Chapter 13. And generally, individuals file a Chapter 13. They give you 5 years to pay back your debt. If you can do it, you're in great shape. A Chapter 11 can be a liquidation or a restructuring. Most people don't know that. A Chapter 11, which is what Sears Holdings Corporation filed, can be a liquidation where you sell everything and pay everybody off, or it can be a restructuring, or it can be both. You can liquidate part of the corporation or several of the businesses, and then you can keep the rest of the businesses. So in our instance, Sears Holdings Corporation had about 10 separate businesses. Most people do not know that. The only businesses that had any significant debt were Sears and Kmart retail stores. But our largest creditor is also our largest shareholder. He forgave that debt to Sears and Kmart and agreed to do it in writing. He said he would take his secured debt, and secured debt is debt secured by property or by inventory. So this debt that was secured by this property and inventory, which was about, and a little bit of the real estate, was about $2.5 billion. The inventory was sold off and the real estate was sold off, and it generated $2.5 billion. Eddie Lampert, our largest shareholder and chairman, took that $2.5 billion and put it into an account to be distributed to all of us. This is all documented. So he was the largest creditor. He sold off the inventory that secured his loans. He sold off the real estate that secured his loans, and he took that money and contributed that money back to the corporation. So where we stand now is that particular $2.5 billion is waiting to be distributed to other creditors and or to us. So what we're going to do is walk through the actual debt in a second and see what's left to be paid. But what we're going to do is go over the actual documents in the case, and I'm going to keep it, I'm not going to get into anything complicated and legal. I'm going to stay very basic so that we don't get, lost in the minutia or the legal language, because it's not really relevant, the complexity of the legal language. I'm going to make it really simple. So we took these 10 businesses into court. Only 2 of them had debt. The other 8 had no debt. So on February 2019, all 10 of these businesses left bankruptcy and they went into a corporation called Transform. Transform is a corporation set up simply to handle the 8 businesses that are going forward and to liquidate the businesses that are not. We have not lost ownership of any of these businesses just because they're not in the bankruptcy anymore. And the $1 million question is, how can you take a company out of a bankruptcy and leave the creditors with nothing? Wouldn't make any sense, would it? Because if you owe somebody money and all you have to do is file bankruptcy and come out of bankruptcy, what would be the purpose of bankruptcy if you were a mortgage company? You could just go file bankruptcy with your house and tell them, I don't want the mortgage on there anymore. So all of the actual debt of any of the corporations, it's only 2, actually is assumed by Transform. it was very little debt owed after Eddie Lampert got his $2.6 billion. A very small amount of debt compared to the businesses, what they were worth, and the cash that was coming in. So the cash coming in from these other 8 businesses is about $1 billion a year after taxes. And I'm going to show everybody the documents on this. So what we're going to do now is Blair is going to play a clip of Bruce Berkowitz explaining what he thought Sears was worth about 9 months or 10 months before the bankruptcy. And listen to this video and watch it very carefully, and then I'm going to finish up. This is a clip of Bruce Berkowitz about 7 to 9 months before the bankruptcy. It's about a 1-minute clip, 2-minute clip, and he's going to explain what he thinks is worth. Bruce Berkowitz is a billionaire investor. He was in another major bankruptcy that I was in called General Growth Properties, and he's a very astute investor, and he is not fly by night. I just wanted to make sure I was clear on that. He's a $1 billion investor. He does not take risk, generally speaking, and he only invests in companies that are considered deep value or value investments. So Blair's going to cue that clip up for you, and he's going to run this clip, and I'm going to give you some more commentary.
The realities of the market. But Sears, many businesses. Sears, there's Kmart, there's the Kenmore brand, the Craftsman brand, Craftsman by Sears now, died on. Insurance company, there's over 100 million square feet of real estate. There's the working capital. There are many parts to Sears, and it's a tremendous asset base.
Right now, all of those things are priced at $7 a share.
Yes.
Roughly speaking. What do you figure it's worth?
At Fairholme, our internal valuation of the assets today is between $90 and $100 a share.
$90 to $100 a share.
That's right. That we've been, people at Fairholme have been doing this for many, many years now. And sadly, our valuations have come down significantly because of the operating losses in retail, but there is still tremendous value with Sears.
So Sears is, as I'm sure you know, the most shorted stock in the Russell 3000. Yes. What do you see there that so many other people don't see?
Okay, thank you, Blair. Okay, so Bruce Berkowitz made about $1 billion in the General Growth Properties bankruptcy, which happened around 2009, 2010. I was also in that bankruptcy. So what's important to remember is that we have closed 90% of the large brick and mortar Sears stores. 90%. We closed these stores at a profit. So everybody can take a look at my document, the 19 facts versus fiction. And if you look at the footnotes, they disclosed in the court record that we liquidated at a profit. And when we filed bankruptcy in October 2018, we didn't have any losing retail stores. Let me make sure I say this again. It is documented in the court record, and it's also documented in my 19 facts versus fiction document that we had no losing retail stores on the day we filed bankruptcy in October 2018. We had already closed the stores that were losing money. So the day we filed bankruptcy, we had roughly 700 retail stores that were not losing money. Let me say that again. We had roughly 700 retail stores the day we filed bankruptcy that were not losing money. None of the other businesses had any significant debt. Real estate had very little debt. 90% of the real estate is unencumbered, and unencumbered in real estate means no mortgages, no liens, no nothing. So the day we filed bankruptcy, we filed not today, but we filed to liquidate the corporation. So we liquidated billions of dollars in inventory, and we closed off, and we sold $1 billion worth of real estate. This is also documented. We also sold, and I'm going to give you some document numbers in a second. And you can write the document numbers down and you can see this information for yourself. So when you liquidate a corporation and there's no corporation left, the proceeds go to the bondholders and the shareholders. We have liquidated so many assets, and so much money has come in. But this money does not go to the company that's in bankruptcy. This money goes to the entity that exited bankruptcy called Transform. So I think what is being misunderstood is people online are following the entity that is liquidating the retail stores that are already closed, and they're looking at the balance sheet of the entity that is still in bankruptcy. But in February 2019, all 425 retail stores, the online business, Innovel Solutions, Die Hard, Craftsman by Sears, Kenmore, the real estate, what's the other big business? Sears Home Services, Sears Reinsurance. All of these businesses left bankruptcy in less than 180 days. So for the last 3.5 years, our surviving businesses have been operating without a bankruptcy. And we sold off a few of those businesses. If you Google Die Hard sold, you'll see we sold that for $200 million. You Google Innovel Solutions, we sold that business for $1 billion to Costco. That money does not go to Eddie Lampert because Eddie Lampert is not the only shareholder of Sears Holdings, and he's not the only shareholder of Transform. The court gave Eddie Lampert permission to take these assets out of bankruptcy as long as we get our pro rata share of the proceeds. But there's a 3 to a 4 year process to liquidate the entire corporation. What's left goes to us. Bankruptcy is very simple. It is not really complex. If your assets exceed your liabilities, the balance goes to shareholders. It's that simple. If your assets exceed your liabilities, the balance goes to shareholders. Right now, our balance is about $5 billion in cash. All this is documented on the court record and can be calculated based on court transcripts and publicly available documents. So we have about $5 billion in cash because we sold. We have the $2.6 billion in cash from Eddie Lampert's conversion. We have $1 billion from Innovel Solutions. We have $200 million from Die Hard. We have more than $1 billion that came from Sears Home Services, and we have another $1 billion from other real estate sales. So these particular businesses have been running profitably, and they have been debt-free since March 2020. So if you go to the Transform Co. website and look up press releases on March 2020, he'll tell you, you'll see the announcement that the company has been debt-free since March 2020. That is our company. We have roughly $700 million worth of bonds that need to be paid off, and everybody is aware of the settlement that we discussed last time. The settlement pays $175 million in cash, and there was roughly a $700 million claim that Eddie Lampert was owed. The cash that he has from that liquidation, he contributed that cash back to the other bondholders. This is documented. I'm going to pull the document in a second. So the bondholders are whole according to the settlement. So this was called a 507B claim. A 507B claim, you can Google this. And this is another thing I've noticed. I've got a lot of emails, got a lot of calls on stuff you can actually Google. And if you can't find something after you Google it, or you have questions after you Google it, I'm welcome with answering. But you cannot read through something or read something online and not Google what it is. There's a lot of discussion about the liquidating trust. So when all of these assets have been liquidated and the cash is in place and the settlement money comes in, they put it into what's called a liquidating trust. It's very similar to a probate estate, as we discussed in the last Zoom. And if you're a beneficiary of a rich uncle, you're just waiting on the assets to be distributed according to the will. The Chapter 11 plan is the will. The Liquidating trust is the actual place that holds the assets and it distributes the cash, the businesses, and everything to us. So Blair is going to play you a clip, and I'm going to play this clip, and hopefully after seeing this particular clip, this will give people a better idea of why the conversation online is not about the actual facts of the case. So Blair's going to play this clip that's going to cover what happens online when people are shorting a stock like Sears Holdings. So Blair's going to cue up this clip for you, and he's going to show you what the anonymous people do and the effect they have on the stock price. I want everybody to understand that there are two ways to make money in the stock market. You can make money if the stock goes up, and some people make money when the stock goes down. It's illegal to publish false information online to make a stock go up, and it's illegal to publish false information online to make a stock go down. They just don't enforce it much anymore. So short sellers are trying their best to make people believe that a company is not worth what it's worth, and their goal is to publish false information or to scare you into selling your stocks or your bonds. And it's very effective. And the reason these people are anonymous is because they don't want to be prosecuted and they don't want to be sued. So Blair's going to play this clip for you. Let me know when you got it ready, Blair. It's a short clip, and I want you to pay close attention because a lot of you are very new to investing and you don't understand how much money is at stake for these people. It's millions and millions and sometimes billions of dollars to get a stock to just drop 10%, 20% on false information. So it's an orchestrated effort to make sure you don't actually have the facts or the information. So Blair, let me know when you got the clip ready.
Eric, can you see the screen? I think this is the one you're talking about, yes?
Yes.
Okay. I can go ahead and play this one now.
Go ahead and play it for me.
Here we
Everybody
go.
pay close attention.
Anonymous articles. Let's say you're even lazier than that. You don't want to deal with journalists, or you want to avoid any potential lawsuits or damage to your reputation. An even easier route you can take is to post anonymous hit pieces about companies on influential websites like Seeking Alpha. Now this may sound kind of silly, like who in their right mind would base their investments on anonymous articles on the internet? But the results speak for themselves. December 2015, anonymous short seller Investor for Truth pushes United Development Funding 4 down 35%. After much speculation, Kyle Bass of Heyman Capital Management reveals that Investor for Truth is him. Ironically, Kyle Bass has been featured on this channel. Bank of California, an anonymous article by short seller Aurelius caused the stock to plummet by 29%, the CEO and vice chairman stepping down, and the SEC initiating an investigation, all from one anonymous article. Bank of the Internet has been the subject of around 30 short seller pieces over 3.5 years, bringing it down as far as 37%. Arrows International, short attacks pushed the Indian Bollywood filmmaker down 50%. Acoustics Technologies, short attacks pushed it down 43% at one point. Why does this work? Because you don't need to convince a lot of people. All you need to do is to instill a little bit of doubt in some. They will sell. Maybe some journalists will pick up the story, giving it credibility, which will cause other people to sell, which will trigger a domino effect of herd selling. And next thing you know, a stock is down 50% thanks to a few anonymous articles, making you at least a 50% return. And maybe if you borrow some money to trade with, i.e. trading on margin, you can make upwards of 100% on just one short attack. And the best part about all these strategies is that it's hard to prove, and the SEC are too incompetent to prove it.
Okay, thank you, Blair. So as you guys saw in this clip, it's a regular thing. There's a current lawsuit that just got settled by a company called Farmland Partners, Inc. And Seeking Alpha was involved in this lawsuit, and they drove the price of this stock down. You can Google Farmland Partners short seller attack or Farmland Partners Inc. versus Fortunae, Fortunae, and you'll see the lawsuit. And Seeking Alpha was involved in allowing this short seller to publish false information on a publicly available public corporation. There are indictments at the U.S. Attorney's Office where they've got 30, 40, 50 people in a room, and these people are in the comment section defaming people who say, I like Sears Holdings. making up information about people. They'll block you on the site. If you publish information to refute the false information, they might just completely kick you off like they did me. So go ahead, John. I'm going to take your question real quick, then I'll continue. Go ahead, John. Blair, John's got a question. I'm going to take his question right now.
Hi there. Well, actually, it was relevant to something quite some time ago. You were mentioning you had mentioned other instances where there were bankruptcies and there was a significant payout to both bondholders and shareholders. And I just wanted to hear your thoughts on whether there was any similarity to, not with regard to the shareholder, but with regards to bondholders. There was an instance with Goldman Sachs where the bondholders were not only paid the face value of the bond, but they were paid all of the accrued interest that had been all of the accrued interest. So I'm just I'm wondering if you think it has any sort of, Sears could have any potential relevancy for those of us who own bonds, and when the payout happens, if it would be any similarity to that. So my question was from quite some time ago. My hand had been up for some time.
No, I didn't see it. No problem. I can go into that right now. Good question. Bondholders are in line before shareholders. Go ahead and mute out. Go ahead and mute out. Thank you.
Okay. Yeah. Thank you.
Okay. So bondholders are in line in front of shareholders. Bondholders are like mortgage holders, and shareholders are like the homeowner. Okay. So in priority of payment, you have senior debt, and then you have junior debt, and then you have shareholders. But we have so little debt left to be paid that everybody will get paid, and bondholders do get interest. So if you have a bond that says 2019 on it, 2027, doesn't matter the date. We've been in bankruptcy since 2018. So your interest is accrued from 2018 on your bonds. So if you have $1,000 face value of a bond, and this is not financial advice, this is only my opinion, but this is a fact. Bonds accrue interest, and the bonds on Sears Holdings are mostly 7 to 8% interest, or give or take. So you'll have the face value of the bond, the $1,000, plus if it says 8%, you'll have 8% for 2019, 8% for 2020, 8% for 2021, and 8% interest for 2022. You may be paid in stock, you may be paid in cash, but when the announcement happens, you'll know. It'll be sent to your broker. It'll be on all the major media, et cetera, et cetera. So what Blair's going to do really quickly is he's going to play you a clip of a payout announcements for Hertz when they came out of bankruptcy. And I'm going to show people, I want everybody to pay close attention to the stock price during the announcement. The payout announcement is $8 a share. I want you to pay attention to the experts, in quotations, guys, and what they say you should do. This is not a pitch to invest in Hertz. The clip you're going to see is the payout announcement with 14 days for payout. I want you to pay close attention to how much they're going to pay out, and pay close attention to what the experts say they're going to do about Hertz. I want you to look at the stock price at the back and listen to what they say. And you tell me if they're rational or irrational. The payout announcement is $8, and this is the day of the announcement. I want you to pay close attention. Go ahead with the clip, Blair.
And Knighthead and Sartori's have emerged as the winner. It's significant because it's the shareholder group that reaps the rewards. A true rarity in such matters. What one participant told me was, quote, truly historic. There's still some moving pieces to get through. The deal has to be approved by a judge. It does allow a group of existing shareholders, though, along with Knighthead, Sartori's, and Apollo, to take control of that company. The bid providing a distribution close to $8 a share. Take a look at the stock. It's up better than 40% today. $8 still a lot higher than $5.24, where the stock is currently trading. As you know, it's all happening at a time when travel is picking up. Hertz wants to take advantage of that too. Weiss, you look at the move today. You know, we did the story last week or so when Kramer was with us. You strike me as the kind of guy who may be looking at something like this, but also you can speak to just how rare it is that the shareholders come out ahead in something like this. It's usually the bondholders and the equity gets wiped.
Yeah, you know, I can go back to American Airlines, and when they filed bankruptcy in 2011, Dave Tepper told me, buy it. I said, what do you mean? They filed for bankruptcy. Why would I buy it? He said, buy it. The assets are worth more than the debt. They're going to restructure. You'll come out ahead. And it's true. I bought the stock at 5, then I bought it at 3 as the rest of the world's puking, and it eventually went to 50. Of course, we can see where it is now. But it's rare that ever happens, and trust me, you got to be very, very knowledgeable in bankruptcy. But this really sets a table. If you want a reopening trade, this is one. Although it's tough for them to buy cars now, and they sold their fleets, nonetheless, there's value in these names. So, yeah, it's rare. You may want to take advantage of it, but let it pull back a little bit first.
Nobody raising their hands to buy this? Joe? Jimmy? You're a car guy.
Nope.
Farmer Jim?
No, listen, I applaud everybody who is in this and make money. This was a speculative play. I mean, there was nothing saying that it was guaranteed you're going to get this payout. It's still a $750 million market cap company. So you're kind of playing on the fringes here. I applaud people who made money on it, but that's not my cup of tea.
Yeah.
I like risk. That's just too much.
I bring it up because, you know, Avis has a lot of debt. Hertz emerges carry with no debt after this process goes through, and we've been talking about a reopen in which Hertz wants to take advantage of a red hot travel market that we all think is going to be there.
Yeah, well, one of the things about Hertz that people haven't talked about much is that they are one of the big owners of cars.
Okay, that's the end of the clip. Okay, thank you, Blair. Okay, did everybody notice that everybody was negative about a stock that was $5.15 and the payout was $8 in 2 weeks? They said, I wouldn't invest in it, it's too much risk. By the way, the payout was actually $14. So in 2 weeks, I made 2.5 times my money after the payout announcement for Hertz. So when the payout announcement happens for Sears, don't freak out if the stock price is not at the payout amount, because people on CNBC who manage lots of money like these people, billions of dollars, when they hear the word bankruptcy, even when it's a payout announcement, I want to make sure everybody is clear. A payout announcement is an announcement of what they're paying you out. It was a 2-week time frame. The money was already at the court. The auction was over. Your money is literally in an escrow account waiting to be paid to you. But those people on the panel said it's too much risk. What risk is it if the money is already up? So that was just one example of how uninformed most so-called professionals are about bankruptcy. Hertz exited with no debt. Avis has debt, and they were kind of touting Avis. One of the guys mentioned how large the company was. Who cares? You could have bought the stock the day of the announcement and made 40% if the payout was $8, and it actually ended up being closer to $14.50. So that's 2.5 times the money. So you cannot look for Wall Street to be rational when it's anything concerning a bankruptcy. Wall Street firms do not have bankruptcy consultants. They don't have in-house bankruptcy specialists and people that invest in bankruptcy. When they hear bankruptcy, they think broke. They sell off their stock and they go away and they move on to something else. Brokers don't make money selling people's stocks in bankruptcy. So you cannot expect a consensus of people online to understand what's going on. If there's somebody online talking about Sears and they're trying to convince you, and Wyco Researcher, Elephant Analytics, these different people on Seeking Alpha do not have experience in bankruptcy. I've got 26 years experience. I've been to trial at a bankruptcy court. I won 2 or 3 appeals at federal court for bankruptcies. I worked major bankruptcies, death row records. I worked TLC's bankruptcy. I was in the General Growth Properties bankruptcy. I was a consultant to the Equity Committee in the J.C. Penney bankruptcy. So these people have not had experience. They have not been in front of a judge. They have not had to file papers at an appellate court to overturn rulings in a bankruptcy court. They don't understand it. And it doesn't make sense for some of you to be in the comment section trying to figure out complicated legal matters that even some of the Sears attorneys who don't specialize in bankruptcy don't know the answers to. So I've talked to some of the lawyers on the case, and they have absolutely no clue what's going on. The lawyers are focused on what their particular part of bankruptcy is. That's it. So if they're working the bondholders, they may or may not know what the payout is, because the people working the bankruptcy, a lot of them are unaware that the shareholders and the bondholders own Transform. So what we're waiting, what we're waiting on now is for the effective date. So they're going to file a motion letting us know when the effective date is coming. They're going to give us new stock in Sears Holdings. They're going to give us some of the cash from the liquidated stores, from Die Hard being sold, from Innovative Solutions being sold. I don't know the amount, but I know we have to get at least 40% of our consideration in stock. That we have roughly, including the pension, if we have to pay it, we have about $1.5 billion in debt and roughly 10 to 11 billion in cash and businesses. Let me say that again. We have roughly 10 to 11 billion in cash and businesses, and only about $2 billion worth of debt left to be paid. If you take 2 billion and deduct 10 billion, you got 8 billion. So our assets exceed our liabilities by about 5 or 6 times. So it's impossible for bondholders not to get 100% of their money plus interest. It's impossible for the balance not to go to shareholders because there's nobody left to pay. Eddie Lampert cannot get the extra money because he does not control our payout. There's something called a liquidating trust, and there is a liquidating trust board. Eddie Lampert's not on the board. He does not control the board. This board has the fiduciary duty to distribute our new stock and the cash to us. So it's a lot of writings online about Eddie Lampert being a crook, us waiting on him to pay us. Eddie Lampert does not pay us. The liquidating trust pays us. All this is solidified by court orders that were approved in 2019 or 2020. Eddie Lampert does not have control of the bondholders' money. Eddie Lampert does not have control of other shareholders' money. Eddie Lampert is just like us. He's a shareholder that owns about 50% of the company, and we own the rest of the 50%. There is no way for him to get control of our money. It's in separate accounts run by separate people. The same way Eddie Lampert can't walk into your bank, or I can't walk into your bank and just say, give me some money out of Leslie Blair's account. Give me some money out of LeBron James' account. We might all be at Wells Fargo. We might all be at Bank of America. Or we might all be at another bank or Morgan Stanley. But I can't go get money out of your account. Now, even if we're all owed money from the same place, if I'm not on your account, I don't have control. So that is another misinterpretation or misrepresentation that's being promoted online, that somehow we're waiting on Eddie Lampert to give us this payout. The liquidating trust is where our assets and cash go. Eddie Lampert will get his percentage. Bruce Berkowitz will get his percentage. Bob Jaffe of Force Capital will get his percentage, and these are large shareholders. Memento in Switzerland will get their percentage, and the largest individual shareholders, such as yourself and some of us, and largest bondholders, will all get a payout, and there'll be a payout announcement. Now, the liquidating trust has already been set up, and I went over the liquidating trust in the last call, and the beneficiaries of the liquidating trust are the same people who were in Sears Holdings, the same bondholders, the same shareholders, the same people. They do not have to list you individually. You're listed as just a creditor or listed as just a stakeholder. The balance of the money goes to us. Let me say this again. We have more cash at Transform than the actual debt we're owed. We have at least $5 billion in cash from the sale of real estate, from the sale of Innovative Solutions. You can Google all of this. From the sale of Die Hard, from the sale of the inventory, and from revenue that came in since March 2020. We have been debt-free at Transform since March 2020. You can look this up on the Transform Co. website under March 2020 press releases. There's nothing left to be paid. All this money is in reserve to be paid to us. Patience is what's important. So the lawyers filed their final legal bills sometime around August 31st. The lawyers have been paid. There are no lawyers left to keep working on this case. The only thing the lawyers can do at this point is close out the case. The accountants have filed their final bills. There are no accountants left to be working on the case. When lawyers and accountants and prime clerks, the people who keep up with all the documents for the bankruptcy, everybody files something called final bill. When you see something that says final bill in a bankruptcy, there's no more money to be made for the attorneys, the accountants who've done an incredible job. You know you're at the end of the case. Now remember, Transform is not a public company. Eddie Lampert controls Lands End, a company that used to be a part of Sears, stock symbol LE. Eddie Lampert also controls SRG, Seritage Growth Properties, which used to be a part of Sears. Eddie Lampert owns about 20% of AutoNation, stock symbol AAN. It is my understanding that we have to merge with or acquire one of those three companies or two of those three companies and become public again in order for us to be paid. Seritage Growth Properties said they are looking for a buyer as we speak. They are voting to liquidate all of their properties or sell to an individual owner on October the 21st. I believe the buyer that will come in with the bid will be Eddie Lampert and Transform, which is our entity. I believe we will merge into SRG and we will get paid out. The vote happens on October the 21st, and we cannot be paid until after the shareholders of SRG vote for the acquisition and liquidation. Eddie Lampert has not made a bid yet, but they say they are still looking for a buyer. So far, I think he's the only buyer. In March, he said he was going to make a bid, and he was an interested buyer. So after the shareholder vote on October 21st for SRG, I think we'll have an announcement. And then what will happen, the next process is a proxy statement will come out to the Seritage Growth Holder shareholders, and they will have to vote on a merger between Transform and SRG, or Transform and Lands End will do it. But Seritage has agreed to be acquired by one buyer and or to liquidate. All of this paperwork is already filed with the SEC, and the vote, I've already cast my vote, it's October the 21st. So we're going to do some type of merger. So it will be an announcement very similar to Hertz. They're going to announce Transform is merging with Lands End. Lands End shareholders will get X per share and X amount of cash or what have you. Transform is going to convert back to Sears Holdings. The actual name that we have for Transform is like a NewCo. It's sort of like a John Doe type of name. It's not really the name of the company. It's like a John Doe. So we're going to convert back into our real name, and we'll get paid. My estimate of the value of the bonds, because we have so much cash, because we have so many businesses, the bonds are worth what they call par plus interest, because the cash to pay all the bondholders was already allotted to us in the settlement that occurred August the 31st. So we're not waiting on Eddie Lampert to push a button, give us a couple of crumbs. He has nothing to do with the payout. The liquidating trust and the liquidating trust board, they do the payout. He receives his money from the same place we receive our money. It's like we're all at the same bank, and for some reason people believe because Eddie Lampert has the most money at the bank, he can just jump into our account or decide what we're going to get paid. Absolutely untrue. And Eddie Lampert in his entire history has no history of ripping people off. He has no significant lawsuits of any significance. He hasn't ripped off anybody in the Kmart bankruptcy. He did in 2005 before they merged with Sears. He does not have a reputation like other people that have been sued multiple times and, rip people off. He's no reputation like that whatsoever at all. And his major investors have not left him. Sears went all the way to about $140. It dropped to 1 cent. It was 4 cents today. Eddie Lampert has not sold a share. It just doesn't make sense for a person this wealthy to hold on to a stock that is worthless. It doesn't make sense for Bruce Berkowitz to hold on to his bonds and his warrants. It doesn't make sense for people this wealthy to hold on when Carl Icahn sold all of his Hertz the day Hertz filed bankruptcy. That is normally what happens. Major shareholders normally sell out immediately. I'm going to show you a quick press release of this really quickly. Blair, I'm going to pull this up. Hold on. I'm going to pull this up on my screen. Everybody hold on. Give me 1 second. I'm going to just show you a quick press release. And this is what normally happens. So I'm showing people what normally happens so you guys can have a better understanding. Let me pull this really quickly. Hold on. My albums. Where can we find it? Okay. Where is it? Can't find it. Hold on. Blair, I didn't send that to you, did I? I can't pull it right now. I'm sorry, guys. So if you Google, go ahead.
I have those 3 images that you discussed.
Okay, so if you Google, okay, hold on, Blair. If you Google Carl Icahn sells Hertz, you'll see that he sold the day or the day after they filed bankruptcy. Carl Icahn is a multi-billionaire, historic, incredible investor, all-time great investor. The second they filed bankruptcy, he just sold off, and he was the largest shareholder. When you don't see the largest shareholder sell off, something's up. That means the value is there. If they haven't sold in 90 days, in 180 days, in a year, in 2 years, don't sell yours either. All right, Blair, pull up that image. Pull up the second image that shows the other bankruptcies. And I'm going to show you guys what happens when major shareholders are still in a bankruptcy. And I think at the top, Blair, it says, it's the screenshot that has U-Haul, Alexander's. It's on the top, it says historical bankruptcy analysis. And Blair's going to pull this up, and I'm going to show you. This came from a proposal out of the investment, General Growth Properties. It was a company that owned 400 malls. They filed bankruptcy around 2009. And this was a proposal explaining to shareholders that the company was still very valuable. The stock was about 50 cents at the time. I think I bought it when it was around $1. I've done some of my own research as well, and I made roughly 50 times my money on that investment. Okay, so if you can see this chart, I'm going to read this off for everybody, and you can screenshot it. I'm going to keep it up here for a few seconds. It says historical bankruptcy analysis. It says we looked at 150 bankruptcies over the past decade to see if we could find any other examples of public companies entering bankruptcy with positive cash flow before debt maturities and asset values in excess of liabilities. Our analysis was limited to US-based non-financial companies with asset values in excess of $1 billion. We could only find 4 bankruptcies that fit the bill. This document is around 2009. It was U-Haul, and most people don't know U-Haul filed bankruptcy, but they did. They reorganized, and the shareholders retained 100% of the post-reorganization equity. The stock price appreciated 450% during bankruptcy, and it increased from $4 to $105 from top to bottom. The major shareholder advocate was a guy named Joe Schoen, and he was the largest shareholder, and he was the one who went out and told people, don't sell your stock. We're not broke. We got real estate. We got other assets. We're not broke. We're having some other issues that have nothing to do with our income and some other stuff. So this guy was a shareholder advocate, Joe Schoen. He did not sell his stock. And you know what U-Haul is worth today. Another company called Comdisco, their management came out and touted the stock and explained to people what it was worth. And the shareholders got warrants and 30% of the company. And the personal recourse management loans were largely forgiven. Then there's Alexander's Inc. Alexander's used to own entire blocks in New York. Alexander's owned the spot where the Bloomberg Tower sits in New York. Google Bloomberg Tower. It's a 45-story building. And Alexander's was a real big store like Macy's, and they were very popular, but they got unpopular, and the real estate they owned was worth so much money that they made a fortune. So the stock went from $13 to $467, and the advocate was Stephen Roth. Steve Roth was the guy who, the largest shareholder, who went out and reorganized Alexander's. So they closed down the stores and they redeveloped the real estate. Does that sound familiar? If you look at my first article on Sears, I'm talking about Alexander's, because we've got enough real estate that we can close down all our stores and redevelop into apartments, condos, commercial buildings, so on and so forth, because we have prime real estate. Over 5,000 acres of prime real estate and land, over 1,100 unencumbered properties. GGP was General Growth Properties. I was in this investment. Blair, get ready to queue up that Facebook post. So GGP ended up returning 100x for Pershing Square, 50x for me. And this particular shareholder advocate was a billionaire named Bill Ackman, and his company is called Pershing Square. And of course, with Sears, we have Eddie Lampert, the Tisch family, and Bruce Berkowitz as the shareholder advocates. And we know what the result is going to be with Sears, because Sears fits this criteria. We have asset values in excess of liabilities, and we actually had positive cash flow before the debt maturities when we filed bankruptcy. If you go to my 19 facts versus fiction document, you'll see in the sworn affidavit from the CFO, he said the stores weren't losing money when they filed bankruptcy. They had already closed the losing stores. So we had the equivalent of a solvent company that needed to restructure in a bankruptcy, because Eddie Lampert had been closing stores all along. So that's what people are missing. We did not. Eddie Lampert didn't just wake up one morning and say, let's go into bankruptcy. He was already restructuring, and he had separated the retail division of Sears and Kmart from the online division of Sears and Kmart, from Kenmore, from Die Hard, from Sears Insurance, Sears Reinsurance, from Sears Home Services. All of these are highly profitable businesses. Our online business has been doing roughly $2 billion a year and 30% margins. You do the math. Sears Home Services has been doing over $700 million a year, and they've been around for more than 50 years, but they're separated from the retail division. We have roughly 20 large brick and mortar retail stores left. That's it, because we were always more than a retailer. We were a holding company. So Blair's going to pull up a Facebook post of mine from around 2009. I was not on Seeking Alpha, and I posted about General Growth Properties in 3 separate posts. And of the people in my friend group, about 3 people just kind of bought the stock blindly, and they did pretty well. But I'm showing this post just so people can get an idea that this isn't my first rodeo. And this post and these posts, you can go to my Facebook page. They're time stamped. I was walking everybody through what was going on with General Growth Properties from when it was $1, from when it hit, I think, $9 or $10, and it went on to pay a dividend for 12 or 13 years of 250% of my original investment. So let me make sure I'm clear with everybody. Assume a $100,000 investment into General Growth Properties. And I want you to think about receiving $250,000 a year paid out in dividends for 10 years. This is a company that was in bankruptcy, that was restructured. Bill Ackman and Bruce Berkowitz, who's in Sears, they restructured the company. So we're not talking about doubling your money. We're talking about turning $1 into $50 with a payout of $2.50 a year for 12 or 13 years until the company was bought out. So I put this post up around 2009, but the economy had crashed. Bear Stearns had went under. Lehman Brothers had went under. Washington Mutual Bank, so on and so forth. Wachovia Bank. So very few people participated. And I just posted this proposal that Bill Ackman put up. I didn't have to show all of my research, because the research Bill Ackman had was further than my research. But the difference between General Growth Properties is there were no short sellers telling people not to buy online. The difference between Sears Holdings and General Growth is there is a crowd of people who seem to say they have no interest in this stock in bankruptcy. They have no money invested. So why are they so angry and upset if you think Sears is worth something? Why would they care if you're going to lose your money on Sears Holdings? Why would it matter to a stranger? Why would they spend their time arguing in the comments, writing articles, misleading you? What do they stand to gain? Because you don't see it on JCPenney's bankruptcy. You didn't see it in the Hertz bankruptcy. You didn't see it in the CBL bankruptcy. You didn't see it in American Airlines. And I definitely didn't see it in JCPenney. And all of these are recent bankruptcies. So these people have shorted Sears Holdings stock. And when the payout is announced, they're going to lose a lot of money. They're losing money when the stock goes from 5 cents to 20 cents because they get collateral calls. So you have to understand what's going on. So do not look to get investment advice online from anonymous people. It's not intelligent because you don't know their motives. If these people cannot show you a court order or a court document or something you absolutely can clearly understand, and I don't mean one document, they need to show you 3 sources at least. And if you don't have a background in bankruptcy law, tax law, GAAP accounting, you're wasting your time. You can go through the 19 facts versus fiction document and you'll see all the proof is cited from the court record. It's cited from the transcripts. It's cited from the court record. The stuff is not, the 19 facts versus fiction document is not complicated. So don't waste your time and energy waiting for a crowd of people to figure out something this complex that I've been doing full time since 2018. Full time. It is a very complex investment, but when it's all said and done, when your assets exceed your liabilities, which they absolutely do, we're going to get paid out. Eddie Lampert's not taking your money. Bruce Berkowitz is not taking your money. Nobody is taking your money. Nobody has control of your money or your stock. No other shareholder has that. The liquidating trust, the motion was filed with the court already. You do not file a motion to set up a liquidating trust if there's no money to hand out and no stock to hand out. It doesn't exist. The same way you don't have a probate if it has no assets. You don't have if the person has no will and no assets, there is no probate because they die intestate, but there's nothing to hand out. So that's the whole purpose of a liquidating trust. The purpose of a liquidating trust, if you Google anything you don't know what it is, I promise you, you will get clarity. You cannot be lazy. You cannot go online talking to other people who don't know what's going on. You'll get more confused. If you Google right now, purpose of a liquidating trust, it'll tell you. A purpose of a liquidating trust is to hold the assets and liabilities of a company that's in bankruptcy. So I will not give a time frame, but I do know it will be after October the 21st. And I think Seritage Growth Properties is the entity we will be merging into or acquiring, because that's the only entity that has been making so many big moves lately, and it's also controlled by Eddie Lampert. So October 21st is the vote, and after the vote, Eddie can make his proposal. I think the proposal is going to be $29 and $30 a share, according to the prospectus. Right now, Seritage Growth Properties is roughly $9 a share. They said in liquidation, it's going to pay you $18.50 to $29. So I think Eddie Lampert might just go ahead and offer the full $29 and close everything out. So I'm not sure about that, but that's a great investment. But the bonds are in the money. The actual settlement that occurred on August the 31st assigns the money to pay the bondholders in full. If you look under the section on the 507B claim, that is what is occurring. It's in legal language, but it's absolutely clear to me that that is what's occurring. So my estimate is that Transform is worth between $9 and $12 billion in cash and assets. I can tell you that the cash that is in those particular, I can tell you that the court record shows that we have at least $5 billion in cash. Okay, Blair, I need you to pull that one document up, Blair. And everybody give me about 30 seconds while he gets that document. 30. Okay, Blair is pulling up this document, and I'm going to give you an idea. I'm going to talk really quickly about the NOLs and tax credits and give you a quick case study. The document at the top, Blair, says transaction overview. Transaction overview. And I'm going to show you what happened in another bankruptcy case I was in. So I think these case studies are going to help everybody, and then we're going to take questions in about 5 minutes. Can you hear me, Blair? Can everybody hear me? Or am I still muted?
Can hear you.
Yes, I can hear you. Hold on one second, E. Hold on one second.
Okay, no problem.
Hear
Yep,
you.
I can hear you.
Okay, got it. All right, so I'm going to keep talking. So this particular company was Washington Mutual Bank. So they went under in 2009, and they had $6 billion of NOLs and tax credits, the exact amount of tax credits and NOLs that Sears Holdings had. Washington Mutual was a great bank out here on the West Coast. They were in Seattle, they were in San Diego and LA, and I absolutely loved them. But they got taken over, I think, by Wells Fargo. So they went a long legal battle with the FDIC over some of the money and the tax credits and the refunds, etc. So when the case settled, Washington Mutual Corporation, here it is right here, Washington Mutual Corporation had $6 billion of NOLs and tax credits, okay? So this company had no other assets. The bank company, the actual bank, was bought out by Wells Fargo. So I'm going to show you in this example, and this is in an article I did on Seeking Alpha, a company with no other assets. I want everybody to be clear. Take a good look at this sheet. This company had no other assets except $6 billion of NOL carry forwards. Those are tax credits and net operating losses. Remember, the bank went under, so they had all of these losses. So this is a shell corporation with $6 billion in NOLs. There was a mortgage company called NationStar. And if you look to the far left, you'll see NationStar. Their market cap was $1.6 billion. That means that's what they were valued according to the stock market, okay? They had 3.3 million customers. The stock symbol was NSM. So Washington Mutual approached them. They approached them and said, why don't we merge? And the deal they came to was that Washington Mutual would merge with NationStar. The company they formed is called Mr. Cooper, which is the stock symbol is COOP. Stock symbol COOP. From the time of this drawing to now, I had stock in Washington Mutual Corp that I sold long ago and bought Sears. But they set up a liquidating trust and they gave us stock in Mr. Cooper on the effective date. So all these conversations online about we're getting wiped out on the effective date because of the liquidating trust, that is a complete lie. They have to cancel the old stock to put us in the new stock. So this corporation with no other assets, no other income, they just had $6 billion in NOLs and tax credits. Sears has $6 billion in NOLs and tax credits, and Kenmore and Craftsman by Sears, and 1,100 pieces of unencumbered real estate, an online business for Kmart, online business for Sears, Service Live, the cash from Innovel Solutions, the cash from Die Hard. We've got all of this stuff plus the $6 billion in NOLs. They merged with a company with a market cap of $1.6 billion. Guess what is ironic? The amount of money to buy Seritage at $29 a share is $1.6 billion. Let me say that again. At $29 a share, you could buy Seritage for $1.6 billion. So we can take the $6 billion in NOLs from Sears Holdings and merge with Seritage, and only counting the NOLs, we could acquire them. If you look up John Willings and Sears NOLs, he did an entire article on the fact that you can do mergers and acquisitions with no assets, just NOLs and tax credits. This company is in existence right now, and it's an incredible value. Mr. Cooper. So they set up a liquidating trust. They mailed me these liquidating trust certificates. They were in my E-Trade account. And when Mr. Cooper merger was finished, Mr. Cooper showed up in my stock account. So when you see that the stock will be canceled, it's being canceled because there's a new corporation being formed. It's not being canceled because you're being wiped out. You can't wipe out a person when your assets exceed the liabilities. That's the only thing that matters in bankruptcy. Do the assets exceed the liabilities? Everything else is irrelevant. So this is a case study of an example. I was invested in Washington Mutual, and I owned Mr. Cooper when this was over. So all this nuance about what's going on with the liquidating trust, don't spend your time, energy, and effort on it. If you want to Google what a liquidating trust is, you'll see the correct answers and information. There is no reason for anybody online to be trying to convince people that they have lost their money on a stock that most people think they've already lost their money on. What incentive do you have? If 99% of the world thinks Sears is worthless, why do you care? Why would it matter to you? So keep that in mind. So this is the process. This chart is very similar to what it would look like. In this particular situation, the Washington Mutual shareholders got 47%. If you see at the bottom under pro forma, KKR, which is a major takeover company, major private equity firm, they took over RJ Reynolds Nabisco many years ago in the 80s. They got 17% because they put the deal together. And NSM, which was Nation Star, they received about 36%. This is probably about what we're going to look like, but we're going to have a larger percentage because Transform is much more valuable. If Transform is worth roughly $10 billion and we merge into a company worth roughly $1.6 billion, it'll be about an 80-20 split or something to that effect. So I think that's what's going to happen. We're going to have to merge with somebody or acquire somebody to be a public company again. Or Transform would have to go public on its own. And I don't think that's going to occur. It appears we're going to merge into Seritage, very similar to this, because just our NOLs can acquire Seritage. No cash, just our NOLs. And this is the perfect example because it's the exact same amount of NOLs that Sears Holdings has, and it's the exact market cap value of Seritage at $29. And that is listed in the plan of dissolution in the Seritage Growth Properties Prospectus. And they actually did a filing fee based on a price of about $29. So I think that's what's going to happen. So after October the 21st, after the shareholders vote for the acquisition and liquidation, Eddie Lampert or anybody else, but most likely Eddie Lampert, he can actually make his offer to merge or purchase Seritage, and he can do the distribution through the liquidating trust. All right, I think we're done. Do we have any questions?